Hi everybody, welcome to the webinar. Happy New Year for 2025. My name is Chris Ashton. I am the head mentor at the Corellian Academy, and today's webinar is focused on the CFD of probably the biggest and arguably the most important stock index in the world, and that index is the S&P 500. Now, whether you are new to trading or have been trading for a while and just wanted to grab some potential insights for the year ahead, this session should be helpful for you. Today, I'll cover the basics of the S&P 500 index, explore how it performed in 2024, and discuss what factors could influence it in 2025. By the end of the webinar, hopefully you'll have a stronger understanding of this important index and some tools to start making some informed trading decisions. Okay, so let's look a bit deeper into what I'll be discussing today. The webinar is broken into two parts. The first is focused on recapping what happened to the S&P 500 in 2024. Here I'll briefly explain what the S&P 500 index is and what makes it so important for traders. Then I'll move on to recap the performance of the index through 2024 using the charts available on the Plus500 platform, before highlighting the key drivers that impacted the index throughout 2024, just in case they become relevant again in the year ahead. In the second part of the webinar, I'll look forward into 2025. First, by delving into topics that could move the S&P 500 index early at the start of this new year, such as the path of US inflation. And then I'll move back to the Plus500 charts to provide some of the potential support and resistance zones to consider, the current trend of the index, and look at how Ballinger Bands can be used to help your trading in January. If you do have any questions, please put them on the chat or the Q&A section of the Zoom webinar, and I'll either answer them at the end of the presentation, or for any specific questions related to the Plus500 platform, a customer service representative will contact you after this webinar is finished. Okay, let's move on. CFD I'm discussing today, the one that you can see on your Plus500 platform, is based on the S&P 500 index, which is one of the most widely followed stock market indices. It contains a collection of 500 of the largest publicly traded companies in the US, and for this reason, it's often seen as a reflection of the US economy. These companies come from a variety of industries or sectors of the economy, making the S&P 500 index a great snapshot of the overall market. If you think of the S&P 500 index as a pie made up of different slices, each representing a sector of the economy, when you trade or invest in the S&P 500 CFD, you're essentially gaining exposure to all of those slices. The index is divided into 11 key sectors, and you can see these on screen for you right now. I've also provided some examples of the individual companies within those sectors, many of which I'm sure you've heard of or even may have traded before. Now, each sector plays a role in the overall performance of the index. For example, the mega technology companies like Apple and Microsoft drive the information technology sector, while the big US banks like JP Morgan Chase and Citigroup are part of the financial sector. The S&P 500 index is a market capitalization weighted index, which means the larger the total value of a company within the index is, the more influence it carries over the actual movement of the S&P 500. You can see a list of the biggest companies and their weightings within the index on the screen right now. So, for example, when you hear headlines about how Nvidia, Apple or Microsoft, the three biggest companies in the world, have seen their share price move in a certain direction, like around the quarterly earnings release, be prepared for the S&P 500 index to be more volatile during that period. And I'll discuss this in a little bit more detail later in the webinar. So how did the S&P 500 index perform in 2024? Well, it was a good year. If we look at the Plus500 chart, and you can see that on screen right now, you can see 2024 was a very strong year for the index. It started in January, on January the 1st, where it opened the year at 4,817. The index briefly dipped to an early low at 4,702 on the January the 4th, before trending higher across the rest of 2024. And this posted multiple new all-time highs until it touched the most recent all-time high, which was on December the 16th, and that was at 6,163, and which at that point the index had actually made a gain of 28% for the year. Now you can see this uptrend more clearly if I add a trend line from the Plus500 charting system to the price chart. I can do this by clicking on the pen icon on the top left of the screen, clicking on the line tool from the drop down menu, then picking the first low in January 2024 and joining it to the next low in April. As you can see, this trend line was only challenged briefly when it was broken for a very small period in time in early August before the uptrend continued. If I draw another trend line from the August lows, you can see the new uptrend continued right into those December all-time highs at 6,163 before breaking lower on December the 18th, after which it moves back lower to close the year on December the 31st at 5,937, an eventual yearly gain of around 23%. I'll use technical analysis to discuss where the S&P 500 could move next later in the webinar. So now let's look briefly at what drove these movements in 2024, just in case they could be relevant again in 2025. The first driver, which was consistent throughout the year, was the strength of the US economy. Early in 2024, traders were concerned that high interest rates may start to weigh on US economic growth. There was lots of talk about whether there would be a soft landing for the economy or a recession, and I'll describe what these mean briefly right now. A soft landing is a situation where an economy slows down to a more sustainable growth rate without contracting. In this scenario, the country's unemployment rate remains low and inflation starts to decrease from higher levels. As a general rule, this is often seen as a positive for stock market indices as consumers continue to spend and businesses continue to invest, which keeps company earnings strong. A recession is more negative. It is a significant decline in economic activity for an extended period, usually defined as 2 quarters or 6 months of negative growth. In this scenario, unemployment usually rises, leading to reduced consumer spending, an increase in bad debts, and declining company revenues and investment. As a general rule, this usually leads to a more negative period of stock market performance. Now, while there were some wobbles along the way, US economic growth in 2024 followed the soft landing scenario, helping to support the uptrend in the S&P 500 index. The big question moving forward is, can this growth continue in 2025? But I'll discuss this later in the second half of the webinar. The next driver that was a dominant factor across the year were the interest rate decisions of the US central bank, known as the Federal Reserve, or Fed for short. Fed interest rate decisions are important for the direction of the stock market because they affect the overall cost of borrowing, which then impacts investment decisions and market sentiment. Higher interest rates makes borrowing more expensive for businesses. This can slow economic growth by reducing consumer spending and business investment, reducing risk appetite and leading to a negative sentiment and declines in the S&P 500 index. While lower interest rates are intended to encourage investment and spending, which can help to boost economic growth and those corporate earnings, usually leading to positive trader sentiment and gains in the S&P 500. Now, early in 2024, traders were concerned that the US economy was going to enter a recession and the Fed were going to cut interest rates, but too late to help support that soft landing for the economy that I discussed earlier. And this debate was consistent across the first 7 months of 2024. And every time you see a dip in the S&P 500 CFD on the screen, as you see right now in those first 7 months, it usually was because there was trader disappointment at the Fed not cutting interest rates. This culminated in the early August sell-off, where US economic data hit its low point for the year and the Fed had still not cut interest rates. And that panicked traders into thinking a recession may be on the horizon. As you can see, that sell-off didn't last long as Fed policymakers, led by the chairman, Jerome Powell, started to indicate around that time that interest rate cuts were on the horizon. And the Fed did in fact cut interest rates 0.5% in September and followed this up with 2.25% cuts in November and December. And that sent the S&P 500 to new highs as a result. However, in the press conference after the December interest cut, Fed Chairman Jerome Powell stated that the US central bank may be slower to cut interest rates in 2025, and this led to that sell-off that you can see at the chart at the end of the year. Suddenly, traders went into wait-and-see mode over the last 2 weeks of the year, which led to some profit taking on year-to-date gains. How this develops at the start of 2025 will be important for all traders of the S&P 500 index CFD. Now, the final driver to consider is sector specific. It relates to the strength of trader sentiment towards the mega technology stocks Apple, Nvidia, Microsoft, Amazon, Meta, Tesla, and Alphabet, also known as the Magnificent Seven. Intertwined with this is the focus of traders on artificial intelligence, which has seen high-end computer chip maker Nvidia challenge Apple and Microsoft for the title of the world's most valuable company, and has also ensured that Broadcom has now jumped into the top 10 most valuable companies in the world list. Trader sentiment towards AI stocks has been positive for several compelling reasons based around its transformative potential. AI is still in its early growth phase with immense potential to disrupt many industries. It has expanding use cases from generative AI and machine learning to robotics and automation. AI applications continue to grow, promising new revenue streams. Revenue growth is important, and companies investing in AI can create innovative products and services, leading to higher customer acquisition and retention. AI chips, cloud-based AI solutions, and AI-driven software are rapidly growing segments with high profit margins. And then we have speculative momentum. Traders don't want to miss out on what is perceived as the next big tech wave, similar to the early days of the internet or smartphones. As you can see from the sector breakdown for the S&P 500 index, which is on screen now, IT dominates the weightings at 32.5%, while financials are a distant second at just 13.6%. Trader sentiment towards these large tech companies went from strength to strength in 2024, driven by strong earnings, robust economic growth, and lower interest rate environment, ensuring that much of that 23% rally in 2024 for the S&P 500 index can be attributed to gains in these key stocks. This outperformance can be seen more clearly if I pull up a chart of the FANG Plus index on the Plus500 system. This is a CFD index made up of 10 of the biggest US tech companies. The FANG Plus index is up 52% in 2024, where it opened in January at 8,730 and closed on December the 31st at 13,272. The question is, can this outperformance for these Magnificent Seven stocks continue in 2025? If it does, the S&P 500 index could move higher. However, if these companies start to fall out of favour, their downside influence over the direction of the S&P 500 in 2025 could be extreme. With that in mind, let's look now and consider some of the potential areas for traders to focus on in early 2025 that could drive the direction of the S&P 500 index. The four areas I think could be important at the start of the year are President Trump taking office, the future trend of US economic growth, the path of US inflation, and the strength of US corporate earnings. Donald Trump was elected the next president of the United States on November the 5th, 2024, with a Republican clean sweep of the presidency in Congress, which is the lawmaking center of Washington. This saw an initial boost to the S&P 500 index at the start of November as traders concentrated on Donald Trump's business-friendly policy promises of less regulation, lower taxes, and higher government spending. However, since then, Donald Trump has used social media to comment about trade tariffs on China, Canada, and Europe. So uncertainty has arisen around how negative this could be for the US and even the global economy. As I said earlier in the webinar, resilient US economic growth readings throughout 2025 kept trader sentiment positive towards US stocks. But this could all change in 2025 if data like gross domestic product, which is released on the 24th of January at 13:30 GMT, comes in below expectations, or traders perceive global trade to be under threat from a tit-for-tat trade war between US and key trading partners, Canada, China, and/or Europe. Other concerns have also arisen around how Donald Trump will fund his campaign promises of higher government spending and whether his growth policies could increase US inflation, with the knock-on effect being the Fed may pause further interest rate cuts or even flip to raising interest rates again in 2025. Now, Donald Trump takes office on Monday, January the 20th, and what he does and says moving forward will be critical for the direction of the S&P 500 index. So be alert and be prepared for volatility. Following on from this, the Fed, the US central bank, have a target inflation rate of 2%. And recent inflation readings like the CPI and PCE index releases at the back end of 2024 have shown that US inflation has stayed stubbornly above that level in recent months. This has provided Fed policymakers with enough of a headache that Fed Chairman Jerome Powell signaled in December that the Fed are on hold until they see more progress on lowering inflation. This makes the next US CPI release, which is on Wednesday at 13:30 GMT, and the PCE index release, the Fed's preferred gauge of inflation, which is due for release on Friday, the 25th of January, of real importance to traders. If these readings are below expectations, that may be seen as good news, as it could allow the Fed to cut interest rates again, potentially boosting the S&P 500, while any print higher than expectations could be taken as a negative and see the S&P 500 fall as fears of higher US inflation and its implications for interest rates and lower US growth are realized. Now, these inflation and growth readings will all feed in to the first Fed interest rate decision of 2025, which is on Wednesday, the 29th of January at 1900 GMT. And this is followed by the press conference led by Chairman Jerome Powell at 1930 GMT. No rate cut is expected, so anything else would be a major surprise for US stock traders. However, the tone of comments from Chairman Powell at the press conference will be important. If he suggests that the early inflation readings are showing signs of inflation's falling back to target, traders could potentially rebuy the S&P 500 as hopes of more interest rate cuts in 2025 becomes more of a reality. If he suggests the path of inflation is still unclear, then it could be taken as more of a negative for US stocks. The final consideration for traders I'll discuss today will be the strength of US corporate earnings. These releases started last Friday, but earnings season really kicks into full gear when the major US banks like JP Morgan, Wells Fargo and Citigroup report later this week. And these are followed by the big technology companies who report earnings starting from January the 24th, when Tesla's results are due for release. If you want to see when a particular company release is due of their earnings, you can use the Plus500 platform. Click on Menu on the top left, go to Tools, click on the Economic Calendar, click on Corporate Events, go to the funnel, uncheck the dividends box, and then utilize the calendar to pick any given day that you choose. As you can see, JP Morgan's earnings are out on January the 15th, which is Wednesday. So there is a lot for traders to focus on in January from the strategy or fundamental side of things. However, when I'm looking at potential trades that I may execute in a particular CFD, such as the S&P 500, I like to consider the charts and technical indicators as well to support any decision making. So with that in mind, let's discuss what the charts highlight concerning key support and resistance levels, as well as technical trends for the direction of the S&P moving forward. If I briefly define what support and resistance are first, support can be identified on a price chart using previous lows. These are areas where buyers have stopped the price of an instrument you may be trading from falling further and then helped it to move back higher again. Resistance can be identified on a price chart using previous highs. These are areas where sellers have stopped the price of an instrument moving higher and then helped it to move back lower again. As a trader, if you believe an instrument is going higher, you can potentially consider buying against support levels that you have chosen, looking for that move back towards the top side. While if you believe an instrument may move lower, you can think about selling against any resistance levels that you have identified in anticipation of them topping the price of an instrument out again and hopefully prices moving back down in later sessions. Now that's the basics, but support and resistance can also be used to identify a sideways range, or an uptrend or a downtrend. If I apply that thinking to the current chart, the S&P 500, by going back to that daily chart that I used earlier from the S&P, we can see an uptrend had been in place since early August. Higher highs and buyers eager to buy dips were helping to create that series of higher lows as well. However, The S&P 500 broke back down of that uptrend line after the Fed rate decision on December the 18th, briefly tested above it and then found sellers into the year end. So the S&P has entered a period of uncertainty. Looking forward, we can identify the low from November the 19th at 5,855 as a potential downside support pivot point. And the index actually closed on Friday at 5,861, so right on that support level. A break and close below this level could confirm further downside price action may materialize towards the next significant low, which is at 5,724, which is the low from November 4th. On the upside, using the daily chart, we can look to the high from January the 6th at 6,068 as a short-term resistance area, as it capped selling previously and could do so again. Although, if prices break back above this level, then traders would probably look to the December 26th high at 6,107 as the next key resistance area. Now, one other technique that we've discussed in more depth in our technical analysis webinars that we put out at the end of last year, which you can also find on the Plus500 YouTube channel, is the use of Bollinger Bands. Bollinger Bands can be used to see which way a particular CFD is trending, but also to identify any acceleration in that trend. This can help with the timing of trade entry that you may be considering and can assist a trader in taking advantage of some of the bigger moves that may occur in a particular instrument. So just as a brief recap, there are three components that you must know with Bollinger Bands: the mid-average and the upper and lower bands. And now I've highlighted these for you on screen right now. The mid-average is the line in the middle, the upper band is at the top, and the lower band is at the bottom. If the mid-average is rising, then the market you are trading is in an uptrend. If it's falling, it's in a downtrend, and if it's flat, it's a sideways trend. The bands move either side of the mid-average, but they reflect volatility in prices. If the bands are widening, volatility is increasing. If they are contracting, volatility is decreasing, and if they are parallel, it identifies a sideways range. Now we can use Bollinger Bands to give us some more color on potential moves in the S&P 500 index CFD at the start of 2025. Here on screen, I have a longer term weekly chart of the S&P 500 index. To add Bollinger Bands to a Plus500 chart, click on the Indicator FX button on the top right of the Plus500 platform. Go down the drop-down list and click on Bollinger Bands. As you can see, the mid-average line, this line in the middle, has supported the uptrend in the S&P 500 nicely throughout 2024. And this mid-average line currently stands at 5,878. And interestingly, the S&P 500 index closed just below this line on Friday. So this could highlight the start of a downtrend in early 2025. Although, as you can see from back in August, much will depend on the price action in coming weeks. If it continues to break lower, then the downside is accelerating. If it dips and then goes right back above it and closes and then continues to move higher like it did in August, that uptrend may still be in place. Now, one other thing that would confirm the next move as traders, we would want to see that mid-average also start to turn lower as well, to back up that potential for a larger move to the downside. In terms of resistance areas to look at, we can also use Bollinger Bands on a daily chart of the S&P 500. And as you can see on the daily chart on screen, price action has already broken and closed below the mid-average. The bands have widened, indicating the potential for future volatility, and the mid-average has started to turn down, suggesting already a downtrend may be in place. The mid-average, which currently stands at 6,010, would now be considered as a key resistance area for traders to focus on for any attempted moves to go back higher. If it caps the rally, that could indicate further downside potential, while any break and close above this area could indicate the uptrend may be starting to resume again. Now, the charts are indicating some interesting possibilities for the S&P 500 index in early 2025. So in summary, before I move on to the questions you've got, it's likely that the index or the CFD, the S&P 500 CFD, will experience a large amount of volatility in the first part of 2025. So keep reading, stay alert, be sure you've got risk management right at the forefront of your mind before executing any trades, and keep reassessing your live trades to make sure that they fit the trading plan that you have created. Right, let's move on to questions.